let's talk about calculating regulatory capital for credit risk, that is, the risk of losses due to defaults or downgrades in a bank's lending portfolio. There are two major approaches, but the internal models approach can be further split into two different ones, which depend on the bank calculating internal ratings instead of using external ones. Let's take a look at this. Similarly to other types of risk, the Basel Accords allow a bank to use, in this case, one of two major approaches to determine their credit risk regulatory capital, where the internal ratings approach can be further split into two approaches. So I guess that we have three approaches in total. Let's start with a standardized approach. Similarly to in other categories, it's about attributing weights and multiplying loan quantities by these. So there are different risk weights that are attributed to different types of loans, and this depends on the loan type, the collateral type, and so on, and also depending on external ratings that are assigned to the borrower itself by credit agency. Then we have internal ratings-based or IRB approaches. This type of approach consists of the bank internally generating credit ratings using proprietary models for this. There are two variations of this approach, the Foundation IRB approach and the Advanced IRB approach, and the difference between both is just which quantitative parameters the bank calculates on their own. So in the Foundation IRB approach, out of the three usual quantitative metrics, which are the PV or probability of default, the LGD or loss given default, and EAD or exposure at default, in Foundation IRB, the bank only calculates the probability of default. Their supervisor calculates the other two. In the Advanced IRB approach, however, the bank calculates the PV, LGD, and EAD all on its own. It's also important to note here that since 2017, the standardized approach is demanded to be used by the Basel Committee as a floor to internal models approaches, currently with a value of 50%. In other words, even banks that use internal models must also calculate the standardized approach using its weights. And if 50% of the standardized approach is higher than the internal model result, then that's the minimum that is demanded. It becomes a floor. Let's start with a standardized approach. It's very simple at heart. We give different risk percentages to different types of loans. There's a full table that can be found on the Basel documentation with all the loan types as a reference guide. But the general idea is that the riskier the loan, the higher its risk weight. Categories include, for example, any claim on retail products, and these are credit cards, auto loans, mortgages, etc., have a weight of 75%. So if you have 10 billion of retail loans in a portfolio, you need 7.5 billion of regulatory capital just for that portfolio, period. Claims secured by commercial real estate have a weight of 100%. If you have 10 billion in these, you need another 10 billion as risk capital. Then you have claims on sovereigns, for example, governments. These are usually very low risk and have different weights based on their rating. For example, sovereigns with the highest rating have a 0% weight. Whether it's 10 billion or 100 billion, you don't need risk capital. Then, the second best tier requires 20% of risk capital, and so on. And what you do is, you simply sum up all the loan totals, each multiplied by their risk weight. It's important to note that these ratings are external, and they're provided by credit rating agencies, or CRAs, Moody's, S&P, and so on. Since the great financial crisis of 2007, these agencies themselves have been supervised by regulators to make sure that the ratings that they come up with are of sound logic, and they have to be transparent to regulators themselves about their processes. And interestingly enough, in the US, since the Dodd-Frank Act in 2010, some regulators stopped using external ratings altogether, completely distrusting the credit agencies and calculating the ratings internally themselves and handing the results to the banks. The second type of approach are internal ratings based or IRB approaches. These are the most sophisticated and they require the generation of internal models to calculate ratings. Both the foundation IRB and advanced IRB approaches rely on the bank's own internal information to rate loans. They all use the three common parameters of credit modeling, including the probability of default, or PV, as a percentage, the loss given default, or LGD, which is another percentage, the exposure at default, or EAD, which is a dollar value, or other currency value, as well as the loan maturity, or M. As mentioned, the key difference between both approaches is that in the foundation internal ratings-based approach, the bank only estimates the probability of default, and everything else is estimated by the bank supervisor. In the advanced IRB approach, however, for the most sophisticated banks, the bank has to estimate all these three metrics, the PV, the LGD, and the EAD. As with other Basel risk categories, the more sophisticated the approach, the lower the capital requirements, because the most simple mechanisms are also the most conservative. In that example, if you have a portfolio just with claims on commercial real estate, the standardized approach tells you it's 100%. So if that portfolio was of 10 billion, you would need 10 billion of regulatory capital. A foundation IRB approach would always be lower than 10 billion, and an advanced IRB approach would probably yield the value even lower than that one. But also, remember, the more sophisticated the approach, the stricter the criteria are for banks to be able to use it. In specific, for a bank to be able to use an IRB approach, their model must, first of all, be well documented so that supervisors can validate the model. What are the goals? How does it work? What are the internal calculations? Is it working as expected? And so on. Then, it must have at least 8 distinct rating categories. And these can mimic the rating agencies' categories, such as AAA, 2AA-, and so on, or they can have different names. They just need to be 8 or more. Here's the thing though, they need to have further granularity within them. So if you have 2 loans that are AAA, for example, they still must have a quantifiable score within AAA. Also, they must reflect real-time data. That is, if there is a change to the borrower on this day or this week, the model should reflect that right away, because a model that reflects changes only from last month or even earlier is just not useful. And finally, it must capture not only degradation of individual loans, but also possible collective issues in the economy, the market, or the liquidity of the bank or the system. This is to capture situations such as, for example, the Great Financial Crisis, where it wasn't just one individual loan being downgraded, but a lot of structured finance products that depended on it were affected as well, creating a shockwave through multiple institutions. What are our key takeaways here? The first is that there are 2 major approaches to calculate credit risk regulatory capital. Banks can use the standardized approach with loan capital multiplied by the appropriate risk weight, an internal ratings base or IRB approach, which further splits into 2, foundation and advanced. As mentioned, we have 2 IRB approaches. The common element of both is that both calculate internal ratings for credit instead of leveraging external ones. The only difference between the two lies in the bank only calculating the probability of default in foundation IRB versus calculating all quantitative metrics in advanced IRB. And finally, given the failure of internal models, or at least the lack of credibility of their results in most cases, the Basel Committee has moved towards requiring 50% of the standardized approach capital as a floor to the model, in the future growing to 72.5% of the standardized approach result. In other words, the standardized approach is going to keep the results of the internal models in check, in a way. So as we see, there are two major approaches to calculate credit risk regulatory capital: the standardized approach and the internal ratings-based approach. The IRB approach in specific can be further split into foundation or advanced, and the only thing distinguishing these two is the quantity of metrics that the bank itself is calculating.